When you look at a stock chart for the first time, it looks like a chaotic wall of complex math. But if you strip away the numbers, you are actually watching a live, physical tug of war. On one side, you have buyers pulling the price up. On the other, sellers dragging it down. Before we step onto that field, remember that trading carries real financial risk. You will lose money while you learn, which is why you should practice these concepts in a simulated environment before ever risking real capital. This animated diagram shows the basic building block of that tug of war, the candlestick. It represents a single block of time, and it has two main parts. The solid block in the middle is the body, and the thin lines sticking out of the top and bottom are the wicks. The body tells you exactly who won that block of time. If the body is green, the buyers overpowered the sellers and pulled the price up. If it's red, the sellers won and dragged the price down. A tall, long body means that side has total momentum and dragged the rope a long distance. The wicks are the tracks left behind in the dirt. They show exactly how far the price was dragged during the battle before the opposing team dug in their heels and pulled it back. Learning to see the struggle within this single shape is the first step toward understanding the behavior of the wider market. Stringing these individual battles together reveals who is winning the wider war. A sequence of large green candles shows that the buyers have total control and are marching steadily uphill. But look at what happens in this animated diagram as the trend continues. The first green block is huge, but the next one is shorter. The third is shorter still. The visual shrinking of those bodies tells you the buyers are physically running out of breath. The upward push is losing energy. If you buy a stock at this exact moment, you are handing your money to an exhausted team. Then you might see this shape at the top. The body is so thin it's just a flat line, with long wicks pointing up and down. This is called a doji. It means neither side won. The tug-of-war is locked in a dead tie. Recognizing that tie at the peak of a climb keeps you safe. It stops you from blindly entering a trade right before the buyers collapse and the price drops. This animated diagram details a falling trend that ends with a highly specific shape called a hammer. You can spot it by its tiny green body at the top and a massive, deeply extended wick at the bottom. Think about the physics of that shape. The sellers yanked the rope far down into the dirt, but the buyers stepped in, planted their feet, and fought all the way back up. It is a massive display of strength, signaling a potential shift in momentum. Now look at the exact opposite. After a long upward climb, you see a small red body at the bottom with a huge wick shooting out the top. This is a shooting star. The buyers tried to push higher, but the sellers slammed the door. At the top of a climb, look for the hanging man. It shares the same shape as a hammer, but that long lower wick reveals that the rope is starting to slip through the buyer's fingers. Shapes alone are not enough to act on. You have to verify them with trading volume. High volume means millions of shares are trading hands. It proves the battle you are looking at is real. Low volume means almost no one is participating, making the shape meaningless noise. Pairing candlestick shapes with high trading volume is how you separate meaningful reversals from random price swings. Let's apply this to a live trade setup. Imagine a company releases positive breaking news. The stock surges upward on massive volume as buyers flood in to grab shares. During that rapid climb, some traders will sell to lock in their gains. This creates a temporary pause in the surge, where the price dips slightly as markets recalibrate. This animated diagram illustrates exactly when to make your move. You watch the dip closely, and you wait for the precise second that a new green candle breaks higher than the top wick of the previous red candle. That break confirms that the buyers have officially retaken control of the rope. You are moving with the weight of the crowd, rather than guessing when the dip ends. Even with clear confirmation, the market can turn against you without warning. To survive, you need an automated defense mechanism called a stop loss. When you enter the trade, you immediately place your stop loss directly below the lowest wick of that recent micro pullback. You are drawing a hard floor in the sand. If the price falls below that line, the original logic for the trade is proven wrong. The buyers lost the rope. The system automatically sells your shares, keeping your loss incredibly small so you can trade again tomorrow. By waiting for confirmation and using strict stop losses, you can participate in these market moves while keeping your risk as low as possible. If this guide helped you read the battlefield, drop a like and leave a comment below. Make sure to follow and subscribe to USFINOX for more elite trading guides.